Hey everybody, I'm Christopher Green. You're watching AMTV, Alternative Media Television. We are back. I'm here with special guest Marco Santarelli of Norada Real Estate Investments. I want to talk about hard assets, specifically real estate today, because the Federal Reserve of the United States, in fact, I got an email from one of our subscribers, and it just said this: Christopher, how did you know? How did you know? You send me a link, I go to the report, the major headline reads this: the Federal Reserve may be preparing for the unthinkable. Negative interest rates in America. Well, how did I know? I certainly don't have a crystal ball. I can't predict the future, but here's what I know. They can't raise interest rates meaningfully without a total collapse. They just can't do it. And again, I'm not just a pundit. I'm somebody who worked on Wall Street for some 10 years. I worked for a major Wall Street firm, managed people's money as a broker. I care about a lot of people. I saw a lot of people hurt in 2008 and 2009. I have a finance degree, studied economics. I've been to both private and public school. I'm not the smartest guy in the world, but I know my work very well. And I know people like Janet Yellen can't raise interest rates meaningfully without a total collapse. And I see a lot of defeatism. People are like, well, Christopher, if it's this bad, what am I supposed to do? It's almost like they just want to put their head in the sand like an ostrich. What are you doing with your money? What are the things you like? And I talk about this all the time. I talk about gold. I talk about land. I actually like land a lot. I talk about real estate. Marco, are you with us?
Thank you.
So, great having you on the show. Thank you for coming on.
Thank you.
Let's dig into this. Where do you think the trajectory of this is going? The Fed potentially could be preparing for negative interest rates, and I don't even think they have to go negative. I don't even think that has to happen. We've already essentially had interest rates at 0% for going on 8+ years. The average business cycle lasts 8 to 10 years, right? They're forming this massive bubble. Trump comes out recently. This was today. It says U.S. interest rates must change as Fed weighs rate hike. How bad do you think this is?
Well, Christopher, I think we're in a world of hurt, and most people don't understand that. If you drink the Kool-Aid from the mainstream media, and I don't watch the mainstream media, they're going to have you believe that everything is fine and that we're in this long economic expansion and that GDP is healthy, the stock market is at another all-time high. That's what you hear virtually every week, is that we're another all-time high in the stock market. But, I don't think it really matters politically who gets elected. At the end of the day, the Federal Reserve is a very powerful body. The politicians, I believe, personally, are just puppets that play into this larger game, this matrix, if you will, of bankers that control interest rates, control the world economies. And so, without going too far on a tangent here, I honestly believe that the Federal Reserve has painted themselves into a corner. They cannot raise interest rates, but if they do, it might be 0.25%. And the only reason they would do that is to save face, because they want to provide people, the world, the illusion that they still maintain some level of control. If they don't raise interest rates, as time goes on, people will start to think that the Fed is less and less significant. If they do raise rates, it'll have to be a very nominal 0.25 point in whatever range they lay out for, the banking institutions. But it won't change anything economically. And you're right, Christopher, they can't raise interest rates because we are so indebted as a country, and many nations are so indebted that the cost to pay the debt it is astronomically high today. And if they raise rates, we're going to get to the point where we're going to be flat out bankrupt.
Yeah, and it's just, it's math. And you don't have to be the smartest guy in the world. What gets me is they constantly tell us that there's no consequences. Like, there's no consequences that rates are at zero forever to infinity. There's no consequences that rates are going negative in Europe and potentially here in the United States. There's no consequences that the national debt has doubled under the administration of Barack Obama, which kind of leads me, I think, to a very important question. Our audience is probably swirling around their head. So if we're in a bubble, right, across, various asset classes, why and how is real estate, for example, as an investment an attractive option?
Well, whenever I hear the word bubble, I have to break it down a little more granular. The question is, what kind of bubble are we in for starters? We could talk about stock market bubbles. We can talk about real estate bubbles. We can talk about bond market bubbles. We could talk about different bubbles. And even within that categorization, you have to start to ask yourself, where are those bubbles? Like if you're talking about real estate, for example, where it is. Let's break this down, Christopher. Let's start with the stock market. I just want to touch on this briefly. So how is it possible that we're in the third longest economic expansion in history? The only other two were 1961 to 1969, followed by the 82 to 1990 economic expansion. So we're in an economy that's been growing for 86 months, and that's a stretch well over the 58-month average that's a post-World War II expansion. But here's the problem. The pace of the recovery has been the slowest in history. The average annual growth right now is about 2.1%, where if you look back in history, it has averaged over 3%. So the United States has now gone on a record 10 straight years without a 3% growth in the real GDP, which is inflation-adjusted GDP. So in the last 85 years, the BEA, the Bureau of Economic Analysis, has calculated that the annual change in that real GDP has been like a 10-year stretch. Let me make sense of that. What that means is we have never seen a period in time where we have not been over 3%, other than in the last 10 years. So in the last 10 years, that real annual growth in the GDP has been subpar or sub average. The last time we peaked was in 2006 when it was 2.7%, but it has never hit that high again ever since. So we're on the longest consecutive stretch of years in which the United States saw real GDP grow by 3% or better. Post 2006. I'm kind of a little scatterbrained here because I'm thinking ahead of myself. I want to.
And I'll just jump in real quick. I mean, that's with the stimulus. I mean, essentially, we have no real GDP growth with the 0% interest rates, the artificial stimulus, quantitative easing to infinity, Operation Twist. I mean, this is all we've got. And, I know there's a great argument, inflation versus deflation. Yes, maybe we see deflation in certain commodities like oil. We've seen oil prices collapse. But I see more inflation around me personally. Cost of food, goods, meat, milk, housing, rental properties, real estate, the stock market. I mean, I see more inflation across the board. Is that your take also?
Yeah, thank you for cutting me off and kind of tying it together. And I'm politically agnostic, so I'm not really trying to tie this to anybody. But if you look at the greatest growth period that we've had where we were 3% consistently, it was 1983 to 1989 during the presidency of Ronald Reagan. But let me tie that back now full circle to the stock market and inflation. So how do you know if the stock market is inflated? And it's really hard to kind of put a measure to that because there's many different metrics you could look at. And if you ask 10 people, you might get 10 different opinions. But here's two things I look at, and I think these are pretty strong. First and foremost, Warren Buffett has gone as far as saying that if you take the total market capitalization, the value of all the publicly traded companies, and I believe that's the top 5,000, and divide that as a ratio into the gross national product, you get a number, you get an index, and he claims that this is probably the best single measure where valuations stand at any given point in time. So if you look at our country's total market cap, which is $21.4 trillion, and you put that over our total GNP of $18.4 trillion, you come out with 1.2. That's the number. And now here's why that's significant. That number is actually, if you want to define it in words, it's super bubble territory. The only other time we've been this high is in 1929, and I'm sure your listeners know what happened then. 1937, 1966, the year 2000, right before the dot-com implosion, and now. So we are back in that super bubble territory. So number two, I'll give you another ratio. and I know you're familiar with this, the price to earnings ratio. This is something that most stock or paper asset investors are familiar with. It's considered a normal range if you're in that 13 to 15% range. If you have a PE ratio of 18 to 20, that's generally considered overvalued. But where are we today? Today we're around 26. The only time we've been around 26 in recent history is right before the 2008 recession, the implosion of the stock market. So again, yeah, we're in extreme bubble territory. Am I concerned? Absolutely. Can you control the economy? No. Can I? No. Can your listeners? Not really. But what you can control, and this is my personal philosophy and my personal belief, is you can control your own personal economy. You can't control the greater economy or the world economy. And I think that's where your listeners need to focus.
Yeah, no, I'm a big believer in that. We were talking about that over the break. And again, I'm a believer too in taking action, right? You just don't sit and look at the world and go, oh my God, this hell, going to hell in a handbasket. And we can all have our opinions. Right? None of us have a crystal ball. I mean, for example, I personally think they're holding up the stock market because it benefits Hillary Clinton. I think the thing is rigged. I think it's a casino. I mean, this is a guy that was on Wall Street. I really do believe. I don't believe it's an organic, supply and demand market where they allow us to have peaks and troughs and, valleys and all this kind of thing. It just doesn't exist anymore.
No, it doesn't.
So I see the wheels coming off. So let's play this out in our minds a little bit. We could have a worst case scenario, post the election. Who cares? You said you're agnostic. Who cares? So Trump or Hillary, whoever gets in, there's going to be hell to pay, in a lot of our opinion, many of my listeners tuning in the not too distant future. That's maybe worst case scenario. The wheels just absolutely, we have another collapse. It's worse than 1929, worse than 2008. I hope to God that it's not. Let's say that's the worst case. Best case, maybe we just kind of muddle along and we get killed through inflation and we just, people are just looking for, alternatives to manage their personal economy. So tell us a little bit more and explain to our listeners. So you've been in the real estate business for years. What do you do that's different in terms of looking at opportunities, looking for cash flow, rental properties, these kind of things that will be able to withstand long-term, either scenario, the worst case, a okay case, maybe even a best case. Maybe they can keep this thing going for a couple more years and they'll take interest rates and slam them to negative 2%, creates even more inflation. I mean, how does all this work out and what kind of things are you seeing on the ground?
Well, you've probably asked me 10 questions in the last 30 seconds. So I'll just kind of throw a dart and start at one place. First and foremost, I think people need to protect themselves by keeping their cash in hard assets, not paper assets, because in paper assets like stocks and bonds, mutual funds, that sort of stuff, the price of those paper assets could vaporize and disappear overnight. You know what the stock market can do. It whipsaws up and down and values will change. Whereas hard assets not only help preserve the purchasing power of your hard-earned dollars, your cash, but it allows you to protect and preserve and basically put it into a safe haven, for lack of a better description. Mm-hmm. So I'm not a gold bug, although I do place cash in gold and silver. I think those are two tremendously good places to put your dollars today. And I have a small percentage of my portfolio there just because it is an inflation hedge and it's a good protection. I don't look at it as an investment because my definition of an investment is something that generates cash flow. Those are the key words, the operative words. If you have regular income coming in, that to me is an investment. So gold, silver, certain commodities I do favor. Real estate to me is ideal, and I say that as both a description as well as an acronym because I'll break what I mean down by ideal here in a second. But you're asking me a bunch of different questions. I'm not married to any one thing, but if I was to go out there and pick the ideal investment, again, no pun intended, I would say it would be income-producing rental real estate. It always has proved itself to weather every economic storm, every recession. The income keeps coming in. The values, I should take that back. The prices change. The value, the intrinsic value of those assets stay the same, but the price does change. So to babble on here a little further, Christopher, let me break down what I mean by ideal, because it is the ideal investment, but it's also an acronym. Real estate gives you income. That's the I in ideal. The D is depreciation. The IRS is, quote unquote, generous enough to give you this phantom write-off for 27 and a half years where you could depreciate that property and take it as a write-off against your passive income. There is no other asset class that allows you to do that. The E represents equity. The equity comes from the equity that's in the property, and that grows as you amortize the loan on that property if you have a loan. The A obviously is for appreciation. What a lot of investors focus on, and I think mistakenly, because it should not be the number one reason you invest in anything, including real estate, but you do have appreciation potential, and history has shown over time that real estate has been very consistent and a good predictor of future appreciation. And last but not least, that L is where wealth can be truly created very rapidly. And I don't mean get rich quick. I mean faster than other options. And the L is leverage. What other asset class out there is a bank or lender willing to provide you up to 80% of the purchase price of that asset for you? In fact, many lenders are tripping over themselves to give you money.
Sure. Well, what came to mind was, well, if you're a hedge fund manager, you can, leverage yourself, 10 times, 20 times to one, borrow at the open, window at the Federal Reserve. But for the average guy, you have limited options outside of real estate where, again, leverage is everything. I mean, Donald Trump talks about this all the time as a real estate, tycoon, really, at least in his own mind. I mean, he's a big believer in leverage. Something I've always believed in is really just kind of hitting base hits. I never believe in any kind of get rich quick scheme. If I do, I'm out the door. I know it's BS, but I believe in base hits, taking action. So, we've talked a lot about this. Obviously, we've become friends. Tell our audience, so how do you find properties? Are you looking, at undervalued markets specifically? Are you in kind of a targeted, price range when you find these homes and then rent them out?
You can there's two approaches here. You can be an active real estate investor. You can be a passive real estate investor. Most people that we talk to and people that call us up are in the latter. They're passive real estate investors. And here's what I mean. An active real estate investor is the one who's going to roll up their sleeves and do most, if not all, the work. They're going to find the deals or try to find the deals, distressed properties, distressed sellers, whatever the case may be. Buy the property, fix it up, rent it, maybe manage it. That's an active approach. Most people don't have the time for that because they're busy. They have a full-time job, they have family, they have Johnny's soccer game on the weekend, et cetera, et cetera. The passive model is attractive to most investors, particularly people who are looking for investments and they, without knowing any better, they end up investing in paper assets like stocks, bonds, and mutual funds. So the passive approach can work out, generally speaking, in one of two ways. You pick a market, you call up a local real estate agent, and you ask them that to find you a property. You can give them a criteria, but they may not even know. And 99% of the time, they don't really know how to work with real estate investors, and that's just a reality. Back in 2004, I started this business because there was such a need, a demand for providing a turnkey solution to real estate investors, where we've already done a lot of that due diligence in picking markets and neighborhoods and properties within that market with tenant occupied, fully renovated properties that are under management. So it's as turnkey and passive as it could possibly be. And that's really what our business is all about. So you asked me about markets. The United States is made up of over 400 metropolitan statistical areas. So the question is, where do you begin? If you have a great market where the numbers make sense, fantastic. That's where you should focus. But most of the time, most people are in markets where the numbers don't make sense. Property values are too inflated. The rent to value ratio is out of line. We'd like to see that around 1%. So a $100,000 property rents for $1,000 a month. That's 1%. That's ideal. But we've already picked about 10 or 11 markets within the United States that make a lot of sense fundamentally, economically. The numbers make sense. There's stability. There's job growth, population growth, and all those kinds of things. So again, that's a 30,000-foot answer to your question, Christopher. Mm-hmm. But I think that gives people. What do you think, and that gives people an excellent frame of reference. What are the quick thoughts like Phoenix? Here we are, the 5th largest city in the country. Is that not an opportunity based on, we've kind of yo-yoed back and forth. I mean, we saw a major collapse 2008, 2009. Prices have kind of come back a little bit. They're nowhere near the peak, but
we've seen some appreciation, especially with these rates kind of putting a floor to the market. Is Phoenix an area you're looking at? Is that a place to avoid? What are your thoughts?
Well, interestingly enough, Phoenix is a market that we've been in and out of twice. And the reason for that is it's what I refer to as a hybrid market. You have two types of markets: linear markets, which are slow, smooth, and steady. Then you have cyclical markets, which many people will be familiar with when you think of coastal markets all along the West Coast, especially California, the East Coast, where you see property values over a 10-year period whipsaw up and down, and they could appreciate or depreciate sometimes in double digits. Those cyclical markets, they're not the best markets to invest in. They're typically overpriced and overvalued, and they can be dangerous. Phoenix is a hybrid of those two. We do see appreciation rates do whipsaw up and down, like more so than other linear markets. But in the last 14 years or so, we've seen two prime opportunities to get into that market where you could pick up properties at great prices and the cash flow is excellent. That now is not the time. That boat has left the harbor around 2013 or so. 2012 was about the prime time to get back into the Phoenix market. 2013 was still okay. You could still find deals in 2014, but it was getting much harder because property values were increasing rapidly and inventory was dropping. Today, you can still find deals if you look for that needle in the haystack, but in complete honesty, you can find better deals in other markets. There's an element of timing, if you know what I mean.
Mm-hmm. Sure. Yeah, and I know you know the market well. I would, just with my limited knowledge of real estate, this is not my area and where I call myself an expert, but 2013-ish, maybe 14, pushing in the right market, at least from what I hear and just being on the ground, being here for 15 plus years, that was kind of the tail end where things were maybe a little bit attractive. Obviously, I've got friends that bought right post the collapse, which was excellent timing, and I don't think they did that on purpose. Maybe some of the smart investors did, but if you're a normal family and you're just looking to put a roof over your head, et cetera, it's tough to predict the future. So how can our audience find you? Obviously, your website, NaradaRealEstate.com. I know you do a podcast. Is the podcast a weekly show that you do? How often are you broadcasting now?
The podcast is a weekly show. It's Passive Real Estate Investing is the name of the show, and PassiveRealEstateInvesting.com is the home for that podcast. So it is a weekly show. NaradaRealEstate.com is actually our property home. It's where we put all our properties, and it's a rolling inventory, so it can change day to day, week to week. And we put a ton of free information about real estate and economics as it relates to real estate. So it kind of dovetails on where you leave off in talking about the greater economy, economics, and politics, and how all that plays into your financial future. Mm-hmm. We kind of pick up where you leave off with that.
Okay, great. Now, also for more information, do you have a newsletter that our audience can subscribe to, or how would they do that? How do they get updates from you?
Yeah, thanks for asking, Christopher. We also put out a weekly email newsletter. It's, of course, free, and we put out one or two articles every week related to real estate or the economics of real estate or financial creating your own financial freedom, that kind of stuff. And we put featured properties in that newsletter too. But you can sign up for that on our website at NaradaRealEstate.com. Okay, great. Well, thank you so much for coming on the show. We'll definitely have you back. And, I just want my audience to understand that it's not all doom and gloom. And I get all these emails, people asking me all these detailed questions. I really want to bring on the experts in a variety of fields so that they can provide value and give actionable advice in some of these areas. It's not, your only option isn't just putting cash in a box or cash underneath your mattress or just simply praying when, like we talked about, you can control your personal economy, right? We don't know what the Federal Reserve is going to do. We don't know if rates get bumped up 25 basis points. We don't know if they run them into the ground, negative 2%. We don't know if there's more stimulus. Those are the unknowns. But you can take action. You can, make base hits. And it adds up over a long period of time. So, Marco, any last words of advice to our audience before we let you go today? Well, just one quick thing. my number one rule out of my 10 rules of successful real estate investing, my number one rule is to educate yourself. Knowledge is the new currency. Don't think of currency as cash or gold or silver. Those are important elements, but those don't come first. Educate yourself, continually educate yourself. Listen to, Christopher's AMTV podcasts and shows. Subscribe to our newsletter and gather other material and just educate yourself. Become financially literate, because when you start to educate yourself, you can start to see through the mess that's out there, and it starts to look like the Matrix. You take the red pill, and now you start to be in a position of control instead of following other people's advice. And that's how you're going to build your own financial and personal freedom.
Absolutely. Well, thank you, Marco, so much. We'll have you on again. I'm Christopher Green. You're watching AMTV, of course. We've got to go to a quick break. Stay tuned.